Good day, everyone. Thanks for joining us on the webinar. We're going to talk about creating tax-free wealth with index life insurance. My name is Denver Noas. I'm here with my colleague Matt Battaglia, and we are with Wealth for Life. Wealthforlife.net is the website. We're going to cover a lot of information today. We do try and keep the webinar under about 30 minutes, and so there will be a replay that you'll be able to access later on as well. So feel free to take some notes, as we go through. But just remember, you'll get a link where you can watch the replay later on as well. So in going over creating wealth with tax-free income with life insurance, I thought it would be good to use kind of a client profile of a typical client I see all the time. Certainly have clients that are younger than this, and certainly have clients that are older than this. But again, I'll see a lot of people in this range. In this example, we're going to use 48 years old, trying to create some tax-free income, wants to save about $30,000 per year, retire at age 62. So if we do that in an indexed life insurance policy, that will produce around $55,000 per year in tax-free income that we could pull out, a pretty good income. Over life expectancy, that's nearly $1.4 million in total tax-free income we could take out. Plus, we would have a death benefit because it's a life insurance policy, $430,000. So that gives us about $1.8 million in total benefits we could take while we were living, and then including the death benefit for having paid in about $420,000. So now obviously that's a pretty good return on investment, and so what we want to do is go through this and see how that is all put together and how the program actually works, using this type of profile as an example. Now, the premier way to grow tax-free wealth is using indexed universal life insurance. It's one of the fastest growing products in the insurance industry. You're seeing almost every major insurance company in the United States offering these, including a lot of the companies that used to love to bash on indexed life, like whole life insurance companies. Were never fans of it, but now even whole life companies are coming out with indexed life because it is a much more efficient way to grow wealth than the old whole life policies. We're going to look at the tax-free status, the way the money grows, the growth potential, how we can actually earn some good interest inside these policies. We're going to look at the cost structure in detail, and we'll go over some case studies, and we're going to look at how to set one up. Well, first, if we start with the tax-free status of things, that is IRS code section 72E and 7702. That's the status, or the actual code in the tax code, that gives us the ability to life policies to have tax-favored status. The money grows tax-deferred, and then you take it out tax-free via policy loans. If you want to do a little more research on this, I would certainly check out Ed Slott. He's one of the top CPAs in the United States. His current PBS special called Retirement Rescue has about 10 or 15 minutes in that special on the tax advantages of permanent life insurance, which he says are really the biggest advantage in the tax code, which they are, because there's no other place where you can go out there and put unlimited amounts of money in, have it grow on a tax-deferred basis, and pull it out on a tax-free basis using those policy loans. The tax benefits of these are well established. In fact, the Wall Street Journal pointed out back in 2010 that the richest Americans already own over half the tax-free investment gains built up in life insurance policies. So the wealthy and the top 1% in this country are already using this to a large degree. Even further on that, if we look at the largest banks in the United States, banks use permanent insurance for their safest assets, which are called Tier 1 capital. For most banks, that's going to be about 10 to 25% that they're going to have invested in permanent life insurance, bank-owned life insurance. You will see all the familiar names there at the top: Bank of America at $19 billion, Wells Fargo $18 billion, JP Morgan $10 billion. So this is not a new strategy. The tax advantages are not new. They're well established and really been used since the 80s, since the TEFRA, DEFRA, and TAMRA laws. That's where they started to become more mainstream. So very well established from a tax-free standpoint, tax advantage standpoint. Okay, so the next section we want to look at is the growth potential and how money grows inside the life insurance policies. When I sit down with clients, and having sat down with thousands of people over the last decade, and I ask them what concerns you the most with the markets and where they're at, and certainly market crashes is one of the things that comes up very often. Everyone's worried the markets are high, what's going to happen in the future, when's it going to come down. People have experienced a lot of crashes, causes a lot of stress and a lot of sleepless nights. So market crashes are a big concern. The next thing that happens, though, after that is when people have kind of gone through those crashes, is they're worried about missing out on upside. If they sit on the sidelines, just like a lot of people did when the markets rebounded from 2008, markets have come back. People sat on the sidelines, money in the mattress, weren't able to earn any money. So that's also a big fear, is missing out on upside. And then third, the biggest fear people have is markets going nowhere. What happens if we have another decade like 2000 to 2010 where the markets are flat and they get no growth? A lot of people are worried that the Fed and the quantitative easing, everything is not going to be able to sustain what the markets are doing. And there's certainly a lot of validity to that. If we look at this chart with this JP Morgan Market Insights starting back in 1997, of course the markets started going up, peaked up here in 2000. After 2000, September 11th, 2001, started crashing, bottomed out in 2003, coming back up again in 2007, bottoming out in 2009, and then again back up to where we're at today at all-time highs. Now there's a fairly predictable pattern there. A lot of people are wondering where the market's going to go from here, but we're just looking at the highs and lows. And I think what happens to a lot of investors is they end up getting stuck in the middle. They just kind of muddle along. Some years market's up, some years it's down, and never really getting a lot of the advantages of the growth. In fact, I had a client that came in and she had added up what she'd put into her 401k for 17 years, and she'd figured out she hadn't earned a penny of interest. And so there's a lot of people out there that are really in that situation, earning a lot less than they think because of the kind of ups and downs of the market. What we want to have is a growth strategy that can be able to perform when the markets are up, down, or stagnant. And I think Index Life has growth strategies that excels at that, and there's three basic components. The first being what's called a market index crediting strategy. That's the insurance company's terminology for the index and the strategy that they're going to use to create growth. Now, the second aspect of that is a 0% floor that protects you from losses, so you don't have to worry about when the market crashes. And then the third is a time frame to lock in gains. So an example of a strategy is an S&P 500 annual point-to-point, 15% cap. That's the cap on the gains, 0% floor, and then they're going to look at a 12-month time frame. So let's look at an example of that. If I have $100,000, we're using the S&P 500, 0% floor, 15% cap, 12-month time frame. Market's up 20%. That IUL strategy is going to be capped at 15, so that 100 grand goes 115,000. Market, of course, is going to be higher, goes up from 100 to 120. Next year, the market crashes, though, drops 20%, something that a lot of people are very familiar with. Now the index life policy stays the same because our 0% floor protects us. Market drops down to 96,000. Market rebounds 20% back up. IUL is up to 132,000, a little more than that, 132,250. Because we didn't lose, we're capturing gains immediately on the next year. The market-based strategy is still trying to get back to its high point of 120, still recovering from the downturns from the year before. Now, this is a very important process in the strategies of Index Life. It's called an annual reset feature. And I think it's another reason, again, when you start doing research on Index Life as a way to grow wealth, you never see any of this type of information in the criticisms of Index Life policies, because most people don't know how they work, and that's why it's easy to criticize things when you don't actually understand how the growth happens. But if I'm starting here at year one, the market falls 20, 30%, my 0% floor protects me, but now I start here in year two. I don't have to wait to get back to even. The market starts going back up in that next year. I'm actually having real growth and real gains, where the actual investor is trying to get back to even. They've just had a flat year because, again, they just rode the roller coaster down and rode it back up, and they had no gain. And this process repeating is what gives us the ability to sustain growth over the long haul. In fact, this chart right here does a very good example of showing this. I know there's a lot of numbers here, but you can download this chart on the wealthforlife.net website. And if we look at the red line is the equity markets, the blue line is the protected strategy, 0% floor, 15% cap. Starting in 2000 to 2010, the market actually had a negative, it was a negative 7.42% loss. The market is called the lost decade. And certainly we've all been very fortunate because the markets have come back up from 2010. So a lot of people have recovered, but that still doesn't change the fact that if you retired in the year 2000, that decade was flat, your retirement accounts were taking big hits because you're withdrawing money, the markets are going nowhere. And that's one big, huge fear a lot of people have right now is, well, what happens if the time that I retire, the markets are flat? Or what if the next 10 years is flat from where they're at right now? What if my timing doesn't match the market's timing? So at that same time frame, this Index Life strategy had a 102.55% gain over the same time frame that the equity markets had a negative 7.42%, a loss. The reason is because we're not losing when the market's down. We're capturing the gains, locking them in every 12 months, and that gives us the ability to sustain growth. And so what you have here is a strategy going forward that has already been proven through flat decades that will allow you to still maintain growth and maintain your income. And index life policies, index policies in the insurance realm are the only vehicles that have these types of strategies. So it's a huge advantage. But in addition to those types of strategies, I'm going to give you a few more examples of what you can find in a good index life policy. So they will have annual point to point. That's one strategy. We're looking at where the market's at 12 now, where it's at 12 months from now. That's called annual point to point. Caps will range from 10 to 20%, although we are getting strategies now that have no caps on the annual point to point side. So if we look at an example, April of 2012, using a NASDAQ 100 strategy, had 11% cap. The NASDAQ for that time frame was up about 15%, so this was capped out. 11% was the yield over that 12-month time frame, the interest credited into the policy. There's other strategies called monthly caps, where you have a 4% type of cap to 4.5% per month. They cap the gains per month. They add up the pluses and minuses of what that index does over a 12-month time frame. And if we look at where it was at November of 2013, the S&P 500 was up, had a pretty good run. So that monthly cap strategy yielded 17.91%. That was the interest credited into the policy for that time frame. Another strategy I'll give you is called a monthly average. There's no cap on the monthly average, has a higher participation rate. We look at March of 2010, markets had rebounded from their low points in 2009. So for that 12-month time frame, the strategy and the interest credit into this policy was 45.7%. A pretty incredible yield in a vehicle that has a 0% floor, no market risk, and on a tax-free basis. And that's, again, with all of these strategies here, this is not to say that this is the type of yield that you're going to get every year in these policies. You certainly will not. But again, when you start looking and researching index life and you look at the criticisms out there of people that say, hey, you're never going to make any money in life insurance, you will never see any mention of these indexing strategies. Most people don't know that within a good policy, you can have 5, 6, or 7, or even 10 strategies, index strategies, where you can change based on market conditions each year and be able to capture very good upside when the markets crash and rebound. And you have a lot of flexibility to capture gains based on different market conditions by having a lot of these strategies in there. And that's what helps to drive the growth inside the policies. So the important question to ask here is, does the strategy you have only work when markets are up? And I always tell people, I know it's great since the markets have recovered 2010 to 2013. How did your strategy work when the markets were pretty crappy from 2000 to 2010? Because that's what you have to plan for. In financial planning, we don't just hope for the best. You have to plan for the worst and hope for the best. So if your strategy didn't work then, how's it going to work going forward when the markets are not doing what you want them to do? So we think a better plan is to have a strategy that works if markets are up, down, or flat. And you can do that by having a floor, the ability to lock in gains, to be able to reset when the markets are down, to capture rebounds. And you have a strategy that has already been proven and already tested, and there's a lot of data on this that you can look at actual real-world results on the index life crediting strategies we have out there. Okay, so that's the growth side of the index life. Now the next thing we want to do is we want to look at the costs of life insurance policies. Again, I know we're covering a lot of information here. If you have questions, enter them in the chat feature. Matt will respond to them, and if we have time, we'll do them out loud here, or at the very least, make sure we email you, to make sure you get your answers. And you'll also, again, get a link to watch this webinar a little later on so you can watch a replay. So life insurance costs. I think that I get a lot of questions on that. It's one of the biggest areas of concern because, again, in researching index life, that's what you will hear about permanent life insurance. It's very expensive. And certainly there are very expensive, bad life insurance policies out there. Some of them work better for income than others. Whole life, I think, is an example of that. Whole life is very expensive. I don't particularly like using it for income because I think it is too costly. Index life is much different. It has a much lower cost structure, long-term, and much higher growth potential. But if we look at the cost structure, all policies are going to have a premium tax, state and federal premium tax, or what is also called a load, that tends to be 5 to 8% one time on the money that you put in. While no one likes paying loads, I certainly think that paying a one-time load of 5 to 8% is a lot better than paying 25, 35, 40% in taxes down the road when I take out money. You're also going to have the cost of insurance. It's going to be based on your age and your risk class, meaning how good your health is. You'll also have expense charges inside a policy, which are going to be based on age and risk class as well. So generally, when you add up all these costs, it'll take 3 to 5 years to break even inside a policy, meaning you're going to be funding it. You're not going to see any real growth in the policy those first 3 to 5 years. You just want to break even as you're building this long-term tax-free asset. But after that, costs will drop by about 75% or more in year 11. A huge drop in costs there, and it really helps to fuel the growth as well. But overall, even when you add them all up, you're going to end up paying about 60% lower costs versus traditional investments. And that's, again, another thing that I think surprises a lot of people is how much less costly this strategy is than the mainstream advice. And we'll use this client that we've been looking at, this client profile, as an example. A 48-year-old client saving $30,000 per year, retiring at 62. And we're going to compare that to buying term insurance, investing the difference, and paying capital gains taxes. So if we look at the index life all policy costs that would have been paid into the policy versus that buy term invest the difference strategy, taxable strategy, we're going to use $127 a month. That's the cost of the term insurance. Investment fees tend to average 1 to 2%. Here we're going to split it down the middle, use 1.5%. On the taxable side, we're going to use the 20% capital gains tax rate. We're going to be a little optimistic, say the taxes aren't going up in the future, and we're not going to include any of the taxes from the Affordable Care Act in that as well. So if we add up all those costs for the first 10 years, what you would have paid in that life policy, $55,369 versus $70,968 in the buy term invest the difference strategy. Now, certainly it's probably very surprising to a lot of people that that traditional buy term invest the difference, which is supposedly the low cost way to do thing, actually costs more. Part of that is because when people always give you these numbers, they never actually add up all the costs. They never tell you what the term insurance costs, what the investment fees cost, and what the taxes cost. So when you add them all up together, it's a pretty big number. And now if we start looking at the 20-year total, meaning what we would have paid over 20 years, that life policy would have cost $73,925 for the total 20 years versus $256,246 in the buy term invested difference. So the term invested difference strategy costs are going up and up and up, over $250,000. Now if we go out 30 years, what we see is $85,139 total cost paid over 30 years in that life policy. Buy term invested difference, $531,018. Huge difference in cost. The indexed life policy saves you $445,000 and $445,879. So a huge amount of savings in cost over the course of that 30-year time frame. How is that possible? Why is there such a difference in cost? It's really very simple. With an indexed life policy, cost is not based on a percentage of that account value. Cost is based on the death benefit. So the larger the account value, the lower the cost. This means when you get down to the point where you're using your income at retirement, your account value is the largest, your costs are the lowest. Versus the alternative traditional investments, cost is based on a percentage of the account value. The larger the account value, the higher the cost. This is why the costs continue to go up over time, and of course it's taxable in that traditional investment model. And this really is a visual of that. This is what we call a crossover chart. This is the point here where where the life policy gets to be cheaper than the buy term invested difference strategy. The red line is the buy term invested difference. The green line at the bottom is the life policy. You'll see by year 5 or 6 where those two lines cross. That's when the life policy starts to get cheaper and the costs start continuing to go down. Where the equity accounts are getting larger and larger and the costs continue to go up. And that's the model of how things work, and it creates a lot more costs because it's based on the percentage of the account value. Now, at our meetings, we can certainly do detailed comparisons. I have a lot of analytical clients who want to go through the numbers line by line. We certainly don't have time to do that on this webinar, but we can sit down with you and break all the costs down and show you all the data if you want to see that as well. Our feelings, though, are all strategies have their place. This is not to say that index life is the only place to grow wealth. We certainly don't think that it is. There's a lot of ways to grow money. In the Wealth for Life, we use a tree to describe our wealth building strategies. Branches of wealth include things like investments, 401ks, real estate, alternative assets, business creation. There's a lot of ways to grow wealth, but we do think that the core of your personal wealth building philosophy, you should have vehicles that are lower cost, tax-free, have downside protection, have steady growth. This gives you the ability to build a strong core. If you can go out there and cover 70 to 80% of your long-term financial needs with things that are protected and tax-free and lower cost, that's going to give you a solid foundation to go out and take more risk with investments and 401ks, do some other alternative asset creation. It's a simple thing. It's just like building a tree. If you're always just using the tops of the trees, which is, again, where most people are starting, and you're not building a strong core, a big storm comes and wipes you out. And that's what has happened to a lot of people over the last decade and even the last 20, 30 years, as we see the wealth numbers of where they are for the country. So having a balanced approach, creating a strong core of wealth, using those low-cost tax-free strategies is a good way to do things. So I'll give you a few examples as we kind of finish up here of some client profiles and some income examples. I get questions about that all the time. Here's a 34-year-old female saving about $1,000 per month for 21 years, $535,000 death benefit required by the IRS. That will give her nearly $55,000 per year in tax-free income for life starting at age 55. This happens to be my wife's plan. We set this up a few years ago. Based on historical growth. So there's not guaranteed numbers like an annuity payout. They're based on the pretty good certainty, though, of what we've seen with those index crediting strategies with the floor and the caps and the annual reset. Here's a 55-year-old executive. We do a lot of executive bonus, putting away $65,000 per year, doing that for about 10 years. IRS required a little over $1 million in death benefit. Be able to take out $71,000 per year starting at year 11. Pretty good income they can take out for life, based on those historical growth numbers. Here's a 46-year-old male that we worked with, had $350,000 in an old whole life policy, had built that up pretty significantly, wanted to upgrade it, make it, put it into something a little more modern that would give a higher yield, but didn't want to add any money to it, didn't want to have any additional savings. And so the IRS required $1.5 million in death benefit. That would give him about $114,000 per year in tax-free income at age 62, tax-free income for life. Pretty good income stream, based on those historical growth numbers. So there really are 5 steps to create a tax-free plan. The first one is you either start with an income goal and see how much you need to fund to reach the goal. So if you want to, get to $100,000 in tax-free income, we can help you figure out what you need to save to get there. Or you just simply say, well, here's how much I can save, and then we look at how much income that will produce. I can save $1,000 a month. Okay, great. We run the numbers. This is how much you'll be able to get out of that based on your time frame. And the goal is, when we're doing this, is we usually try to keep your current spending the same so you can really enjoy life along the way and not just try and scrimp and save and put money away. And we can usually do that by redirecting or optimizing what you're already doing, so that you can keep your spending levels the same and just do things a little more efficiently, and we can usually get there. So also, choosing the right type of policy is absolutely critical. There are a lot of bad policies out there. A lot of people don't know how to set them up right. There's policies that don't have enough indexing options, that can be too expensive. And again, a lot of bad insurance policies out there and people that don't know what they're doing setting them up. So you want to make sure you're in the right policy and correctly setting them up. And one key to that is buying the least amount of insurance the IRS requires for your goal. And so the least amount of insurance is very important. That's the biggest mistake I see often. People are buying more insurance than they need. So again, you want to match the amount of insurance with your savings goal. You want to fund it to what's called the 7-pay limit or the MEC limit. So you want to make sure that you're buying the least amount of insurance required. That will help keep the cost down. Common questions, we'll go through a few of them. We're running a little bit short on time, so we may not be able to get to all the questions that have came through the chat. But again, we'll email you, and then you'll also be able to watch this webinar a little bit later on replay. What age ranges will this work for? Again, we have clients. I started a policy on my daughter when she was 4 months old. I have clients that all the way up to age 70, early 70s, starting the strategies, because there's ways to make it low cost even at those ages. So it will work for all different types of age ranges. You want to just sit down and make sure it matches your overall financial situation, make sure it's appropriate. What if I have health problems? You can also actually be the owner of a policy and not be the insured. Meaning I can have, if I was uninsurable, I could have a policy on my daughter. I could own the policy. I could control access to the cash. Everything would be as if it were mine. She would just be the insured, so you actually don't have to be the insured. You can own it and have it on someone else. Has to be an insurable interest though. So kids, grandkids, nieces, nephews. If you can make a case for insurable interest, you can do it. Can the IRS change the laws? Of course, IRS can do anything they want. Last time they changed them was in the 80s, the Teffer, Deffer, and Tamra laws. Back then, when they changed the laws, people that were already into the strategies were grandfathered in. We expect that precedent will hold when they do make changes, which they, certainly it's on the target list for Congress. It has escaped the 2014, Congress, but we expect that they will look at it at some point in the future. So you'll be grandfathered in, is what most attorneys will tell you is their opinion on it at that point. What if I need to change the plan or bail out? Nice thing about indexed life policies is that they are flexible. So even if we come up with a 5-year savings goal and we decide halfway through we need to change it, you just change the goal. You can reduce the death benefit on the policy. You can stop saving into it. You can change it at any time. Now, certainly, though, if you do bail out within the first 5 years of the policy, they do have surrender charges, and you're going to lose money. So you want to make sure that you try not to bail out, and we try and make the policy fit your financial situations, because if you do cash out early, you're going to lose money. But we can always change it, which is usually what we do. Very rarely do I ever see clients have to actually cancel a plan. What can go wrong or make the plan fail? One, I think, is setting it up improperly, buying too much insurance for how much you want to save, or creating too aggressive or unrealistic of a savings goal. You want to be very conservative and realistic on what you can save in, because if someone comes in and they say, hey, I want to save $20,000 a year, and then they're only able to save $2,000 a year, the plan's not going to work. And I've seen that happen. Other agents have set that up. Someone says, yeah, I think a couple of years from now I'll be able to save $50,000 a year, even though they've never saved more than $5,000 a year in their life. Agent sets up this big expensive policy. Then all of it goes to costs and commissions, and that's not good. So there's a lot of ways you can make the plan fail. Being realistic about what you can save, and then if you have to make changes, make changes. That's the only other thing you need to do. If you get to 5 years and you need to change the plan, no problem. Just make sure you change it. Just don't let it sit there. Always make sure that you're on track with your goals. And that's why what we do is we sit down with clients every year, make sure we're on track. If we need to make changes, we change them. We have spreadsheets where we check the actual performance versus what we thought it was going to be, and we keep adjusting the plan. So those things are all easy to remedy if you're working with the right people and you set it up in the right way possible. Next steps, you want to evaluate your potential tax threat. Based on your income and your spending levels now, we want to take a good look at what kind of estimate you're going to have with taxes down the road. What are the impacts going to be in your retirement? And you want to start seeing how much of your assets you have in a taxable versus a tax-free position. We can help you evaluate that. And you want to look at this in a big picture context. When will your wealth run out, during retirement? Are you on track to that? Are your savings on track? Do you need to optimize things and make them run a little more efficiently? And then again, start moving to increase the tax-free income portion there. The green color there in this little screenshot is just the tax-free income sign. We want more green. We want more tax-free. And these screenshots are all just some of the tools that we can use to help you evaluate that and get a good look at your overall situation there and evaluate the potential tax threats you're going to have down the road. And that starts really with just a phone call. You can talk with us directly on the phone about your situation. We love the technology, we love the email and all this interesting things we can do on the web, but we're still very old school, and I always kind of believe you want to talk to us on the phone, just pick up the phone and give us a call. We'll chat with us directly. You won't get an answering service or anything like that. So you can also email me or email Matt. Our contact information is here on the screen if it's easier to schedule a time for a phone call. We're all pretty busy, we know that. So feel free to email us, schedule a time, or with any questions you have. And I want to thank you for taking the time to watch this webinar. I appreciate that. I know you're busy, and I know it takes a lot out of your schedule to do this. So look forward to hearing from you, and thanks again.